Hello viewers, and welcome to today's episode of the Mrs. Amma Show, and this is the Money Talk segment. So I am super excited. If this is your first time joining me on this show, welcome. Don't forget to hit the subscribe button and join my family. So on today's vlog, we're going to be talking about the basics of investing in the stock market. It's funny because I was speaking with a subscriber of mine the other day, and he was basically telling me that whenever he just hears anything about the stock market, he just gets so overwhelmed and it just kind of like goes over his head. I mean, he feels like he's just so lost when it comes to investing in the stock market. He would like to learn how to invest in the stock market, but it is just so overwhelming. So if you are anything like him, you probably also feel overwhelmed. I don't know if in recent times you've stumbled upon, finance shows on TV, so like on CNBC, on Bloomberg, and whenever they start talking the jargon, do you feel like, what in the world are they on about? Does this sound like Greek to you? Would you like to learn more about investing in the stock market, but you'd like to have someone put you through, sort of like give you a more down-to-earth guide on how to invest in the stock market? Well, you have come to the right place. Here on the Mrs. Amma Show, Money Talk segment, I seek to empower you on how to have a second source of income. So your first source of income is your job, your 9 to 5. It is imperative that in addition to your 9 to 5, if you want to build sustainable wealth, you have a second or a third or multiple streams of income. And investing in the stock market is a great way to have a second source of income. So on this vlog, this is going to be, in the end, it's going to be probably going to be a 4 or 5 part series on how to invest in the stock market, because I really want to break it down. I don't want to rush, and neither do I want to have a very long blog, that lasts maybe close to 45 minutes on just investing in the stock market. I really don't want to bore you guys. So I'm going to chop it up into bits and do like a 4 or 5 part series. It depends on how it pans out. So this is series 1, and it's just going to be on the very basics of understanding what it is. What are some of the terms you hear on TV, on some of these finance shows or money shows? Some of the terms they throw out there that seem like jargon to you, I'm going to break it down to the very barest minimum so we can all understand. So without further ado, I'm going to delve right into it and give you 5 basics, what I call 5 basics of investing in the stock market. Number 1 is the markets. So just as you and I would go to the grocery store, or you go to the fish market, or you go to the meat market to try and go buy, meat or fish or groceries, the stock market is also a market that brings buyers and sellers of various financial instruments together in one place to trade. So it's also a market, it's a stock market, it's a market where buyers and sellers of financial instruments come together to trade. Now, it is governed. So markets or stock markets are often governed by exchanges, what we call an exchange. And so the exchange really governs and facilitates such trades. Because at the end of the day, for it to be an organized system or an organized methodology, then there need to be rules and regulations that govern trading in the stock market. In the US, for example, we've got your New York Stock Exchange, so the NYSE. In the UK, there's a London Stock Exchange, and in Germany, there's the Frankfurt Stock Exchange. So exchanges really are there to ensure that law and order are the order of the day, and people, buyers and sellers come together to trade in a peaceful and governable manner. So that's 1, the markets. 2 is the broker. Now, unlike where you go to the meat market, or you go grocery shopping, or go to the fish market, and you can pretty much like haggle prices, you can't exactly walk into an exchange. So I can't exactly walk into the New York Stock Exchange and tell whoever I meet there, or if there's a seller there, and tell the seller, hey, I want to buy stocks. That's not how it works. You will typically go through what we call a broker. So kind of like you have an insurance broker, where if you need to buy a car insurance or you need to buy life insurance, you go through a broker. It's the same concept here with the stock market investing. You go through a broker, and for a small fee, the broker will then take your order. So you place your order with the broker then takes your order to the exchange and fulfills the order. in these days, I mean, I know I'm painting it as you work with a broker. The broker then takes your trade, goes to the exchange and facilitates it. These days, everything is done electronically. Gone are the days where people actually physically went, to the exchange, or like brokers went to the exchange. I mean, there's still some brokers who sit on the exchange or sit on the floor. I will get to it at a later vlog. But in these days and times, everything is done electronically, and there are tons of online brokerage companies where you can open an online brokerage account in order for you to be able to invest in the stock market. In a later vlog, I'm going to be discussing about such online brokerage companies and which ones I find, or which ones I find very useful and very user friendly. So I'll be making my recommendations then. So that's 2, is the broker. So 1 is the market, and then 2 is the broker. 3 is what I call the index or the indices. So typically in a stock market, when you hear the index is up or the market is up, the market being up or the market being down is as a result of what's going on with the index or these indices. So an index is pretty much it's an instrument with a basket of companies. It's a basket of stocks of underlying companies in that jurisdiction. So for example, here in the US, you have what you call the Dow Jones Industrial Average 30, or for short DJIA 30, and that index is made up of 30 of the largest US companies by market capitalization. So the Dow Jones Industrial 30 is made up of companies, the 30 largest companies in the US. There's also the S&P 500. I'm sure a lot of us are familiar with that, or we've heard it. So again, the S&P 500 is an index, and that index is made up of stocks of 500 companies in the US. Other jurisdictions have their own indices. So in the UK, for example, there's the FTSE 100. Just like you guessed it, it's made up of stocks of 100 UK companies. So that's it. So when you hear, the market is up or the market is down, it's really the companies, the performance of the underlying companies in each of these indices or index that go up and down. So based on what the performance of the Dow 30 is doing, so if, for example, most of the companies in the Dow 30 or most of the companies in the S&P 500 are doing very well, and the performance is up, what you'll find is the S&P 500 index will start to go up, and traders or the market or and then the stock market will say, the market is going up. On the flip side, if performance is not really well, maybe they had a bad quarter and they and they missed earnings, or for whatever reason, and the performance of the company is going down, you hear that the stock market is going down. So it's really the indices that move up or down, and based on what's going on, we say, the market is moving up or the market is moving down. So that's 3. It's a concept of the index or indices. Number 4 is diversification. So it is imperative that in the stock market, when you're investing in the stock market, you have that culture or that concept of diversification. I mean, the term, have you ever heard the term, don't put all your eggs in one basket? I mean, that is so applicable here. You don't want to have a gambler's mentality of taking all of your money. So for example, if let's just say you've got $10,000 to invest in the stock market. Don't take the entire $10,000 and go buy several of one company's stock and expect to hold it, within, just for, 30 days to 90 days. That is not how it works. If you want real long-term success, you have to have a medium to long-term investment horizon, and you also have to have the culture of diversification. So take that $10,000, for example, and instead of investing in just one company's stock, like buying a lot of one company's stock, so instead of buying just a lot of Coca-Cola, for example, buy a little bit of Coca-Cola, buy a little bit of McDonald's, buy a little bit of Blue Apron, buy a little bit of Caterpillar, buy a little bit of United Healthcare, buy a little bit of stocks in companies in different industry sectors. And so at the end of the day, once you pool and you have a stock portfolio made up of different companies in different industry sectors. You are well diversified, so that if something is going on, for example, within the healthcare industry, and there's a scare or there's some outbreak, and it's really hurting the healthcare companies and their stocks are tanking, you could find that while the value of your stocks in the healthcare company is going down, the value of your stocks in Coca-Cola, for example, or the value of your stocks in McDonald's could be going up. And so that would help to balance out your stock portfolio. Versus if you had all of your $10,000 invested in United Healthcare and the value of that stock starts to go down, you will be in trouble. So you can see the concept of diversification here. It is key. Diversify. So that's 4. Number 5 is bulls versus bears. What? So the first time I ever heard, back then when I ever heard of the concept of bulls versus bears, I went around just looking for okay, so where's the bull and where's the bear? Why are we talking about animals here? So it is not animals. Yes, bulls, bears, they're animals, but it is not animals. What this simply means in the concept of investing in the stock market is when the market is up and has been on an upward trend for the last several days, so maybe a week or the last 10 days or even the last month, people in the stock market, so traders or experts in the stock market, typically say that the market is experiencing a bull run, which means it is on an upward trend and it has had that trend now for days, which is good. So when you say, the market, we're in a bull market, all that simply means is the market has been on an upward trajectory. On the flip side, when you hear the term we're in a bear market, all that simply means is the flip of it. So the market has been experiencing steady decline over the last few days or over the last few months. So bulls versus bears. A bull market just simply means the market is in an upward trend, and a bear market means the market has been consistently being on a downward trend. Don't be overwhelmed. Don't let it feel daunting. Once we get the hang of it, it is super exciting. You start to make very calculated moves, and you start to really watch your money grow, and you start to make very educated decisions regarding your money and investing it in the stock market. So I am super excited. I can't wait. This is just it gives me the gratification just knowing that I am able to impart some of the knowledge, the small knowledge I have about it, but it's very empowering once you can take control of your finances and have this second stream of income. So until the next time of the Mrs. Amma Show, I say you stay well. If you're new to this vlog, welcome again. Don't forget to subscribe, hit the subscribe button, and recommend, share my vlog. Send a share to your friends on Facebook, send a share to your friends on Instagram. Follow me on Instagram for tips, useful tips on how we can become financially free. You stay well.